the markets are high and they're about to go down. You should sell your stocks.
Okay.
They then go down. Does exactly what you thought it would do. But now the markets are going to turn around. You should buy your stocks again, right?
Yes.
It's the whole adage of sell high and buy low.
Mm-hmm.
How often
Works
does
every
it work
time.
that way?
I say works every time with a heavy dose of sarcasm.
Yes. We make it worse.
We're our own worst enemies,
Mhm.
and that's what we're going to talk about today. And a good example of that you just gave of what we want to do in theory. And
I mean, it sounds so simple.
yeah, well, like everything, it sounds simple
Right.
when there's no emotion involved. It's not actually happening.
Like growing grass.
All right, growing grass.
It sounds so simple, except when it doesn't rain for 2 months.
Or as Mike Tyson said, everyone has a plan until they get punched in the mouth.
That's right.
That's the reality
Yep.
is. And, you know, so we're talking today about how we as investors make things worse.
Yep.
And time again, we truly are our own worst enemies. And despite what we all may think, we do have the greatest impact on the performance of our investments, not because we're smart, but because so often we feel the need to take action and regain a sense of control or maintain a sense of control when it feels as if it's being lost because we let our emotions get in the way. And so that's going to be the focus of what we talk about today. And I'm starting to hear this more and more from clients' predictions about where the market's going.
I got one yesterday.
Yeah.
And
Do tell.
Well, we just had to take a step back and talk about the fact that our view is never to try to time the bottom of the market, because as the client was letting me know that they felt the Dow Jones Industrial Average was going to fall to this specific number, that it's entirely possible, but it's also entirely possible it never gets there.
Mm-hmm.
And it's important to remember that we're all very intelligent, and I certainly think I'm more intelligent than I am in my own opinion.
Sure.
But trying to pick a number or trying to place a view on where the market is going to go is just a guess.
Mm-hmm.
And one thing that we never want to do is leave our clients' retirement and their financial health up to a guess. And so it's important to remember why you're investing in the first place. Because if you're owning stocks, equities, as we often refer to them, same thing, chances are you're not owning them to buy them at a specific price and in 2 months sell them. If you really want to build wealth over time, you're seeking to buy that investment and own it for the next 5, 10, 15 to 20 years. And whether you get it at the Dow Jones Industrial Average trading at 31,000 or you get it at 28,000, in the grand scheme of things over a long-term time horizon, not going to make that much of a difference.
No, and trying to predict where something or anything is going to go or what is going to happen requires things to operate and work a certain way.
Yes.
Markets are irrational. They don't often act rationally. You can see a company may come out with very good earnings and say, hey, we were so profitable this past quarter, we grew our profits by 20%. And you would think, all right, well, the stock's going to go up. And then we see the stock down 4 or 5% the next day. And you think, well, that doesn't make any sense. And that happens all the time.
Sure.
In math, if you have 2 and you add 2 to it, you know that you have 4.
Right.
But markets are not nearly as rational as that. And therefore, it is impossible to predict what is going to be happen because we don't know how other investors...
in the short term.
In the short term,
It's
we don't
impossible
know.
to predict
we
what
don't
will
know.
happen in the short term. But we know over the long term, good quality investments work well.
Which is why so often in times like this, when you hear someone say, well, I think I can see my investments going down to this number. Well, yeah, they may. And I even had someone send me a very detailed breakdown of how much money needed to be lost every day for their portfolio to go to zero. And I chuckled at it, but also there's an understanding that people are concerned.
Yeah.
That's someone who is afraid or really concerned. And then we kind of talked.
And it doesn't mean that they're wrong
No.
with those feelings, because when you see your account just go down, it's unnerving
Sure.
and it's unsettling. And as human beings, it's natural for us to be afraid or be worried, or in some cases, even be very fearful and panic by that. That's completely normal to experience that.
Yeah. So,
But we have to think about, why are we doing that?
yeah. And so the question I've gotten from some folks lately is, well, what's the plan right now? And the plan right now is not very exciting, but it is, hey, let's just keep doing what we're doing.
Well, and
For the most part.
The reality is, we've also, in a lot of cases, built a plan.
Yes.
Not one that we're now trying to build today after the market's down 20%, but a plan that we built years ago that we will continue to execute on that plan by sticking to the original plan and not changing things when we're experiencing short-term volatility, even though it seems like we need to do something because as human beings, we just feel like we need to do something.
Yeah. And I would love to be able to say, all right, this is exactly what we're going to do. We'll make the 10 following changes and adjustments. That's going to turn everything
And your
around.
account will be back, and you don't have to worry about these daily declines to zero.
It's all fine.
Yep.
It will all be fine. That's
Right.
going to take care of it. When you don't feel well, you go to the doctor. Often they'll give you a prescription, and maybe that takes care of what's wrong for the
Yeah, and
time
after a couple days, you start to see some
being. Right.
progress.
This isn't the same way. But
No.
the question is, are we just saying that because we don't have anything else to say, or is it a decision or a recommendation that is backed with data, with context, and with real-world experiences?
And rational thinking.
Right. And the answer is yes. There is a lot of data to this. And there was a study that was done over the 30 years from 1991 to 2021.
It's mind-blowing, but not surprising.
Yeah. What's also mind-blowing to me is that we're closer to 2050 than we are 1991. The 1990s to me don't seem that long ago.
No, they don't seem that long ago at all.
And my chair is sliding down, so I have to adjust it.
That's because I come in here
yeah,
before
right.
you come in, and I start messing with it just to irritate you.
So,
But I get your. But the 90s,
they
it
don't
seems
seem
like
that long ago.
Seems like just yesterday we were hanging out in Batavia, New York on Fridays with TGIF,
Yeah.
pull and peel licorice and the popcorn that Dad made.
Never liked that pull and peel licorice.
I didn't.
I didn't, but I liked
I
the
favored
popcorn.
regular licorice. Pull and peel, it's
Yeah.
fine. Got the job done.
I think there's a reason you don't see it around too much anymore. It's kind of a fad, but
Consumers ultimately have the say.
they do. They do. So back to what we're talking about. This study that covered a 30-year period showing what had the most significant impact on investment returns. It wasn't the stock market itself. It wasn't the bond market itself. It wasn't even inflation. It was us. It was investors. And not necessarily in a good way. Because the study compared stock and bond returns with mutual fund and eventually exchange traded funds, sales, redemptions, basically tracking, are people selling, are they buying, what kind of adjustments are they making over a 30-year period of time. Pretty telling. The average return of the S&P 500 over that time was 10.5%. Government bonds. Now, again, it's a 30-year study. Government bonds didn't really do much the last decade or so, but in the 90s, it was a little different. Government bonds averaged a return of 5.3%. The average investor, 4.1%.
40% of the S&P and less than
Yeah.
government bonds.
Worse than government bonds.
Yep. 20% less.
Why is that?
Emotionally driven decisions. And it's natural, again, as human beings, for us to do that. But the stock market is the one area where when everything goes on sale, 20 or 30%, everyone runs for the hills. Yet if you put a big sign out in front of Target or Wegmans, whole store, 20 to 30% off, the parking lot would be packed.
I heard someone said this the other day. When socks go on sale, you don't go to your dresser and throw out all your socks.
Right.
You go and look and see if there's anything else you need.
Mm-hmm.
And maybe you add some to it, but you don't throw everything else away
Right.
just because it's on sale. And that is very fitting here. The other thing I think there is sometimes, we do think we are smarter than we really are.
Yes.
We do.
Yeah.
There is the emotional component.
I think everybody does.
And we all do. I do. We all do. And we all think, no, I know what to do here.
Yep.
And it's okay to not know.
Right.
There have been multiple conversations I've had lately where the answer to a question of, hey, what's going on with the markets is What is going to happen is I don't know over the next 6 months. I don't know over the next
Well,
year.
and the reality
I
is
don't know.
no one knows, but there's plenty of people who think that they do.
Right.
And thinking that you know what the market is going to do, and as such, acting on that is the reason why the average investor's return is 60% less than just the S&P 500 over
Right.
30 years. That's precisely, we all think that so many people just turn on CNBC. You're going to hear an endless cycle of people talking about what the market's going to do, where it's going to go, and yet no one knows.
No one knows.
So let's not even try to attempt.
And sometimes the greatest action you can take is to take no action at all.
Right?
That can also be the most challenging action to take,
Absolutely.
is to take no action at all.
Because it's far easier to just sell everything. You don't have to worry about it tomorrow. But in a scenario like this, when you choose to you choose inaction over taking an action, you're saying, I'll take more pain because I don't know what tomorrow brings.
We had this conversation with our kids the other night about choosing your hard, choosing which hard you want. Meaning the point being, let's say that our older daughter is very into Irish dance and saying, do you want to practice now? Maybe you don't want to practice now. Or do you want to put yourself in a better position to have the results you would like in the future when you go compete? Choose the hard. Maybe it is harder to practice now, but would it be harder in the future to be disappointed because you didn't perform as well as you wanted? Choose which hard you would like. Would you like it to be hard now or to do something maybe you don't want to do? Or in the future, would you rather be disappointed or say, I wish I had given that a better shot? With your investments, we have to choose which hard we want. It is hard. It is difficult right now to stick it through. Do you want that hard? Or do you want the hard of saying, I wish I hadn't done that?
I will take today's challenge over regret.
Right.
10 or 15
And
years
that's
from
it.
now.
And that's what we're trying to avoid is regret. Fear and anxiety. We're trying to do our best to keep that from turning into regret.
Right.
So what do you do? All right. It's very easy to talk and give these great quotes and theories. What should someone do right now? If you're feeling this thing, I don't know what to do.
Take a deep breath. Maybe take a couple. And ask yourself, is what I'm thinking about doing, is it being driven by data and facts that I believe will put me in a better position 10, 15, 20 years from now? Or am I doing this because I'm a human being having a reaction to a situation where there's uncertainty and I'm fearful and I feel like I need to do something? And ask yourself, what am I hoping to achieve by making this decision?
Do I have an investment plan?
Right.
Does this decision align with that? What I mean by that is that it's very easy to do a back of the envelope calculation when everything is going well of, do I have enough money or will I have enough money to retire? It's not that difficult. Spoiler alert.
Right.
It's not. You don't need some fancy software to do it. You need about 10 minutes and a pen and a piece of paper.
Yep. Excel spreadsheet will make it even easier for you.
Excel spreadsheet will make it easier. But it's not that difficult.
Right.
Where it becomes of value is now when you may look and see, my investments are down 15%. Am I still on track? How does that match up? Okay. Well, now if I feel the need to make some of these choices, we can compare that or hold that up against, well, here is what you have said. Here's what we've determined you need to be able to retire comfortably in terms of income, in terms of maybe purchasing a second home in 10 or 15 years, in terms of being able to transition from full-time work to part-time work, in terms of being able to help your kids afford college. It's a lot easier to make those decisions if we can say, does this fit or does it not fit with what we have determined is most important?
And think, does this decision make today easier for me? Or does it make 10, 15 years, 20 years from now easier for me? Choose your hard. Do you want to deal with it today? Or do you want to deal with it 10 years, 15, or 20 years from now? Because there will be a challenge. I suggest we just get it over with.
Agreed. Agreed. And if you can get this current market situation over with, that would be great too.
Yeah, we'll just stick to our plan.
Let's just stick with the plan. Avoid those emotionally driven decisions, but also recognize that it is very easy for us to become our own worst enemy when it comes to investing.
And don't be afraid to ask for help.
Yeah.
Because every single one of us has emotion in our lives and in our retirement. A coach, a third-party person, can often help bring objectivity and rationality back to your thoughts because that individual doesn't have emotion in your life and in your retirement.
A coach can provide the window from surviving into thriving. And that is where the value lies.
That's right. We'll see you next week.
This is Wade into Wealth.